Welcome to The Explainer. Today, we're diving into a fascinating and, let's be honest, pretty unsettling idea. That the global economy is in a slow burn crisis, one that's building towards a sudden rupture. The pieces are all there, but they're kind of hidden in plain sight. So let's connect the dots. It all really starts with this paradox. On one hand, you see all the headlines celebrating a resilient economy. Stocks are near all-time highs. But then you look just beneath the surface, and the reality is record public debt and this deep structural fragility. So how can both of those things be true at the same time? That's really the core question we need to unpack.
To figure out where we might be headed, the analysis first looks back in time, and it asks a pretty chilling question. Is history about to repeat itself in the worst possible way?
And this is where those historical parallels start to get really scary. The analysis draws a direct line from today's aggressive tariffs all the way back to the 1930s. It also sees these eerie echoes of 2008's massive debt problems. The critical takeaway here isn't that we're just repeating one crisis. It's that we could be facing a dangerous combination, a toxic cocktail, really, of several of them all at once. So how in the world did we get here? Well, the paper traces a pretty clear path. It all started with the cheap money policies right after the 2008 crisis. Then, of course, came the massive COVID stimulus in 2020, which just piled on even more debt. But according to this analysis, two recent events really poured gasoline on the fire. A massive stimulus bill in July, followed just a month later by a huge escalation in tariffs that basically threw a wrench in the gears of global trade. So, with that historical context set, the paper drills down into what it identifies as the three core domestic risks that are acting as the fuel for this fire. The first big risk is fiscal overextension, and this number says it all. A single, record-breaking $100 billion auction of very short-term government debt. Now, why is that so scary? Well, it means paying for long-term expenses with short-term loans. It's exactly like paying your mortgage with a credit card. Sure, it works for a minute, but you become incredibly vulnerable if interest rates suddenly change. The second risk is protectionism. And this chart tells a really stark story. Average U.S. tariff rates have absolutely exploded to levels we haven't seen since the 1930s. And look, this isn't just about trade. These tariffs, they act like a tax that drives up prices, creating a major inflation headache for the central bank. And that leads directly to the third risk, a central bank that's caught in a totally impossible position. This quote from economist Glenn Hubbard really highlights the trap. See, with tariffs pushing inflation up, the Fed is being pressured to cut interest rates anyway. But if it gives in, it could lose all its credibility and, ironically, cause borrowing costs to spike, the exact opposite of the goal. But here's the thing. These domestic risks, they aren't happening in a vacuum. The rest of the world is watching, and as the paper shows, it's already starting to react. One of the clearest reactions is what the paper calls systemic hedging. Countries like China are buying gold, and I mean a lot of it. You have to understand, this isn't just an investment. This is a strategic move away from the US dollar, and it signals a fundamental loss of trust in the world's traditional reserve currency. At the exact same time, we're seeing this dangerous market complacency. The S&P 500 might look strong, but the paper points out that market breadth, that's the share of stocks actually rising, is the weakest it's been since 1998. It's like an army with only a few healthy generals out front, while all the soldiers are sick. The front line looks strong, but the foundation is just crumbling. Underpinning all of this is the erosion of something more abstract, but absolutely vital: institutional credibility. This is the bedrock of a modern economy, the belief that the official inflation data is accurate and that the central bank is truly independent. As this trust declines, investors demand higher returns to compensate for that added uncertainty, and that raises borrowing costs for the entire system. So, let's recap. We have fiscal strain, we have tariff-fueled inflation, and we have crumbling trust. The paper's final section tackles the critical question: how does this slow-burning fire suddenly become an explosion? The paper warns of a vicious feedback loop. It starts with tariffs pushing inflation higher. That puts pressure on the Fed, which weakens its credibility. Then investors get nervous and they demand higher interest rates on U.S. debt. And of course, those higher rates blow a hole in the government's budget, which creates even more pressure. And the cycle just begins again, getting worse each and every time.
And that brings us to the core thesis. The next crisis, the paper concludes, won't be a simple repeat of the past. It's going to be a dangerous hybrid. A crisis of confidence in our institutions, crashing head-on into a system that's already brittle from decades of debt. So the paper doesn't predict when a crisis will happen. It concludes that all the flammable material is already piled high. All the conditions are in place. The only question left is, what will be the spark?